Hello everyone, welcome to Scholars Club. Today we'll be talking about the profit and loss statement and the balance sheet, and this is the standard format which will be followed for statement of profit and loss and balance sheet. This is according to the Companies Act 2013. According to the Companies Act 2013, every company must follow this pro forma to report their profit and loss statement. So in this video we will be talking about this profit and loss statement and the items in the profit and loss statement. The first item is revenue from operation. In respect to the company, the revenue from their operations, such as sale of their products or sale of their services or any other operating revenues, and if it is a finance company, the interest or the revenue from other financial services will be taken in this revenue from operations. Next, number 2, other incomes. The other incomes like commissions, dividends, interest received, commissions received or dividends received, these can be written in other income. Now number 3, total revenue. Adding of number 1 and number 2 gives us number 3, that is total revenue. Remember number 3. And number 4, we will be talking about our expenses of the company, and number 4 consists of these items. The first item, cost of material consumed. The cost of material consumed, that we can also call it as the raw materials consumed. So that is an expense to the company. So from the trial balance we will be getting these information as how much of the raw material is consumed. Purchases of stock in trade. This we can easily say about this as purchases which has happened in the year. Then changes in inventories of finished goods, work in progress and stock in trade. We generally get these by calculating our closing stock and opening stock. So deducting the amount from closing stock, the closing stock and the opening stock, we get the changes in our inventory. And next we'll employee benefits expense. Employee benefits expense is the only single term used for salaries, wages, contribution to provident funds, employee stock options or employee stock purchases or staff welfare. Everything will be given only under this employee benefit expense. Next, the finance cost. Finance cost in the sense the cost respect to the finance, that means the interest expense or any other borrowing cost, these come under finance cost. Next, depreciation and amortization expenses or other expenses. So as the name suggests, the depreciation and the amortization expenses which happen in a company. Generally the depreciation happen because the company will be having any plant and machinery, buildings, so the depreciation and the expenses like amortization and any other expenses which do not come under these categories will be written in depreciation and amortization expenses and other expenses. So now we will be getting total expenses by adding these. So now coming to number 5, we call this as profit before exceptional and extraordinary items and tax. That is number 3, that is total revenue minus expenses. Revenue minus expenses gives us profit, and we call that profit in Companies Act 2013 as profit before exceptional and extraordinary items and tax. So that is 3 minus 4. So we get number 5. Then we'll move on to exceptional items. Exceptional items should be written here. Any exceptional items like prior period items or raw materials under broad heads or gross income derived under broad heads, those are called as exceptional items. That is in number 6. Then coming to number 7, profit before extraordinary items and tax. So in the number 5 it is profit before exceptional and extraordinary items and tax. In number 7 it is profit before extraordinary items and tax, because from the profit before exceptional and extraordinary items and tax we are deducting exceptional items, that is 5 minus 6. So we get number 7, profit before extraordinary items and tax. Then in number 8 we write extraordinary items. Extraordinary items generally occur when any fire accidents or natural calamities happen and the company may get lost due to that. Then we consider that as an extraordinary item and then we write that here. So in the 9th we get profit before tax. So we are removing extraordinary items from number 7, because in the number 8 we are deducting extraordinary items from number 7. So 7 minus 8, the profit before tax. In number 10 we get tax expense. In the tax expense we will be having current tax and deferred tax. We have to consider the tax rates prevailing in the country and we have to deduct the tax. Then we get profit or loss for the period from the continuing operations. That is the same thing as 7 minus 8 here. Then we get profit or loss from discontinuing operations. See, this is for continuing and this is for discontinuing operations. Generally the companies have continuing or discontinuing operations. See, these items will only come if it is mentioned in the trial balance or any adjustments while preparing the statement and a statement of profit and loss. Next, tax expense on discontinuing operations, even that should be deducted. And in number 14 we'll be getting profit or loss from discontinuing operations after tax by deducting these two. Then in number 15 we'll be getting profit or loss for this period, that is 11 minus continuing operations minus discontinuing operations. And at the last, number 16, we'll be getting earnings per equity share. Earnings per equity share should be calculated and given in the profit and loss statement as per how per equity share, per one share, how much is the earning will be given in number 16 column. So this is the standard format followed for preparing the statement of profit and loss for a company. Next comes our balance sheet, and the balance sheet in Companies Act 2013 will be following a vertical pro forma, not a horizontal pro forma like we prepared in our previous video. Companies Act will be following a vertical pro forma. This is the balance sheet, and in the balance sheet we will be writing equity and liabilities. Under the first heading we used to just write liabilities in our previous balance sheets. Now we are writing equity and liabilities. As we spoke already, liabilities are something which we owe and assets are something which we own. See, in equity and liabilities, in the number one we'll be having shareholders funds. In the shareholders funds we'll be talking about share capital, the capital, and the reserves and surplus. They can be capital reserves, security premium reserves, or capital redemption reserves, or any other reserves. And number C, money received against share warrants. The money received against the share warrants will also be calculated in shareholders funds. In the number 1 we will be having share capital, reserves and surplus, and money received against share warrants. Number 2, share application money pending allotment. The share application money which we received or which are pending allotment will also be written in liabilities in number 2. And in number 3 it is non-current liabilities. The non-current liabilities, we also know the liabilities under 12 months or 1 year, which can be written off in 12 months or 1 year. We call them non-current liabilities. In the long-term borrowings, A is the long-term borrowings. They can be classified as bonds, debentures, or term loans from banks or any other parties, deposits, loans and advances. These all comes under long-term borrowings. And deferred tax liabilities and other long-term liabilities. These can be trade payables. We used to call it as bills payables, not trade payables. And then long-term provisions. Long-term provisions are others like some employee benefit provisions. They will be given in these non-current liabilities column. Then they come to current liabilities. Current liabilities which can be written off within 12 months. See, non-current liabilities which cannot be written in 12 months or 1 year period. Current liabilities are written off in 12 months or 1 year period. They are short-term borrowings, like the short-term borrowings which can be taken in the form of loans from banks below 12 months. So they are short-term borrowings. The trade payables, they are within 12 months. The other current liabilities like current maturities of long-term debts, any income received in advance, unpaid dividends, these come under other current liabilities. And short-term provisions like the short-term long-term provisions like employee benefits or any other things in short-term, in below the 1 year time period. These are called, and these are the liabilities column in the balance sheet. And next comes the B column, the assets column. The assets column, the non-current assets, assets having the value of assets which can't be turned to money immediately. Those are non-current assets. In the non-current assets, it has a sub-column of A. Those are fixed assets. And in the fixed assets, we have tangible and intangible assets. Tangible assets are, as we spoke in our previous videos, land, buildings, plant and machinery, furnitures, vehicles, office equipments. These come under tangible assets. And next comes our intangible assets. In our fixed assets, we discussed about tangible assets, and now it is about intangible assets. And intangible assets are something which cannot be seen. They are goodwills, brands, any softwares or rights, the trademarks, logos. These can be called as our intangible assets. Next, capital work in progress. The capital work in progress, and the capital which is in progress can be written in this third item. Next, the intangible assets under development. Any goodwill or any trademark which we have applied and we are still to get them, so we can write that as intangible assets under development. And B, the non-current assets. Non-current assets, we have discussed about current assets. In the current assets, we have discussed about tangible, intangible, capital work in progress, and intangible assets under development. In the non-current assets, these are non-current investments, not non-current assets. Non-current investments in the sense trade investments and other investments, which also can be called as investment property or investment in equity instruments, investments in preference shares, government securities, debentures, mutual funds, any partnership firms. These called as non-current investments. And deferred tax assets. The tax assets which we'll be speaking this when we do any problems about deferred tax assets. And long-term loans and advances. The long-term loans and advances which the company has given to anyone. They are capital advances or company security deposits or any other loans and advances for a long period of time, are long-term loans and advances. There are other non-current assets. The other non-current assets in the sense the long-term trade receivables. The bills receivables, we used to call them as bills receivables, the long-term trade receivables. we'll be calling it as trade receivables. They can be secured, unsecured, or they can be doubtful, anything. So they should be written in other non-current assets. And the second thing in assets is current assets. Because of the current assets, they can be easily converted. They are current investments. The current investments which are easily convertible, they are same as the non-current investment. These are current investments. In the same way, we will be investing in investments in equity instruments, preference shares, debentures, bonds, mutual funds, government securities. So these are current investments. And next, the inventories. Inventories in the sense the raw materials, the work in progress, finished goods, stores, loose tools. They will be written in the inventories. Next, the trade receivables. It is the trade receivables is the amount of trade receivables outstanding for a period exceeding 6 months from the date they are due for payment. So they will be written here in the trade receivables. The period exceeding 6 months from the due date of the payment, they will be written in the trade receivables. And next, the cash and cash equivalents. Cash and cash equivalents, cash in hand or cash at bank, checks, drafts, they can be written in cash and cash equivalents. Short-term loans and advances. Short-term loans and advances in the sense the loans and advances for a short term, that means within a year, they can be written in short-term loans and advances. See, as these are assets, the short-term loans and advances are loans given by us, not taken by us. Loans given by us because the amount is given by us, so they should be considered as current assets. And the other current assets, the assets which doesn't fit into these categories will be written in other current assets. So this is an explanation of all the items in our profit and loss statement and balance sheet. In the same way, the liabilities and assets will be balanced in our balance sheet as we get our profit or loss from our statement of profit and loss, and we'll be carrying that to our balance sheet and we'll be balancing our balance sheet. So this is the standard format followed by every company with the help of Companies Act 2013. This pro forma is followed by every company. And in our next video, we'll be solving a problem on preparing the statement of profit and loss and balance sheet. We call them as financial statements. These both, the profit and loss statement and balance sheet, are called as financial statements. So we'll be solving a problem on financial statements from a trial balance where we'll be having some adjustments. So we'll be solving a problem with note numbers very clearly from where the revenue from operations has happened, adding them or any outstandings, anything, or depreciation. So we'll be solving a problem in our next video. So if you like the video, please like the video and please don't forget to subscribe my channel. Thank you.